Hey everybody, it's Mark Yagi. Welcome to another weekly stock market update. Glad you're here. And it's been a fun market. We just got off our mastermind call just 2 minutes ago, and there's some happy people in there, a lot of smiles, and mostly bald guys in there today. Kind of I felt at home. But anyway, it was fun. Let me jump right into it because you don't want to hear me rant on about nonsense. You want to talk about the market probably. So today is February 16th, and we are in, gosh, you see when this market went green, this was way back on November 6th, and that was when we really caught a primary trend, as we call it in our program. And if you've been involved in this market and haven't been scared out by the news, don't watch the news, okay? But if you've been scared out by the Fed or whatever, interest rates or Putin or whatever, like you're not helping yourself. Like, we have market timing indicators for a reason, and in our program we use them. So we got 4 green lights, and I mean, even though this has been probably 3 times as long as most green light periods go, it's still strong. So we're not letting off. We've had some, sell-offs 3 days ago, 4 days ago, but we're not letting off. So market's green, got to treat it as such. Okay, NASDAQ Composite had a big gap down, filled basically most of the gap here yesterday and today. We're up near all-time highs on the NASDAQ. We're up near all-time highs on the S&P 500. We're up near all-time highs on the Dow Jones Industrial Average. We're up, at all-time highs right now, today on the New York Stock Exchange Composite Index. And even though oil is selling off and gold is not doing that well, the New York Stock Exchange Composite Index, which is the broadest index that I follow, is doing extremely well. That means the stock market's doing well. That means hopefully you've been in the market since some part of November, into December, into January, into February, and you're in the right stocks. That's an important thing, because it's a market of stocks, everybody, right? So if it's a stock market, a market of stocks. So if you're in the market and the market's going up, you have a 70% chance. Well, let me say it a better way. 70% of the action of your stock comes from the direction of the market. And so if your market is going up, your stock is probably going up, because the stocks make the index, not the other way around, right? Everybody's like, oh, the market's pulling it up. No, the stocks are moving up. And you have to follow the Fed. You have to follow the money, no matter what. If you're studying politics, or you're studying religion, or you're studying history, or you're studying the stock market, you've got to follow the money. When the Fed is in money printing mode, or the government, let me say better, is in money printing mode, the markets move up. Well, they're in money printing mode. They're just not telling you they're in money printing mode. Where do you think all the money for all this deficit, all this spending? Hey, let's send some to Ukraine. Let's send some over here. Let's study the cow farts in the atmosphere and how that's affecting climate change or whatever. They're just blowing money. Nobody's talking about reining money in. Where do you think that's coming from? It ain't coming from our taxes. Our taxes are now less than the national debt. Interest on the national debt is bigger than our military spending. Like, it's gone out of whack. So how do you think they're paying for all that? They're printing money, but it's not the Fed printing money anymore. Guess who's printing the money? The Treasury. So now the Fed's like, well, we're not printing money. We're trying to bring inflation down. Over on the other side of the bridge, the Treasury's like, yeah, I'll just keep printing, buying T-bills. So the Treasury's putting money into the T-bill market. Maybe this is too much that you don't want to know, but if you don't follow the money, you don't understand which way the markets are moving and why. And so this year is the second year of a bull market, right? Last year, January 9th, I called a bull market, and we're in the second year of it now. We're 14, 15 months into it. I don't see it abating, because we had high interest rates. Inflation has come down from 8 or 9%, they say. It's higher than that, to 3%, they say, and they're still targeting 2%. I don't think we're ever going to really get to their number of 2%. I know my eggs are not up 2%. I know they're up quadruple, triple, double, whatever. I know yours are too. Your meat is more expensive. Your drinks are expensive. Your fast food is now 20, 25 bucks to go out for 2 people for fast food. Like, things are not 2% higher than they were last year. They're a lot higher. And so they're telling us it's going to get back to 2%. Okay, use their numbers. They're never going to really get back to 2%, I don't believe, because at some point they're going to have to print money and print their way out of this. They're having to refinance all this debt, and I'll be done here in a second. They're having to refinance all this debt that was at 2% on average. Now it's 5, 6, 7%, because they're raising rates on themselves to try to quell this inflation. And when they refinance that debt, they have to pay market rates. Well, market rates, nobody's going to buy the debt for 2% anymore when the market rate is 7. So now they have to charge 7% to the government. So it's a spiral. So now that's going to have to increase. They're going to have to print more money to finance the debt. I'm actually in Buenos Aires, Argentina right now today. Inflation was 21% last month. Last month, it was 21%. What is that? Multiply that out. It's 140% a year. That's the official rate, right? Like they don't even know what currencies to take around this joint. It's crazy. That's why I'm here. I want to study the inflation and how much it's hurting people, helping us with the dollar, but these people are hurting. And you think we're seeing inflation now? You haven't seen anything yet. So the best way to hedge inflation is to be in hard assets, real estate, stocks, Bitcoin, gold, whatever. But be in hard assets. Don't be in foofy assets, right? So, and when you follow the money, you know the direction of the market over time. You're betting on a direction of the market because you know the direction of the US dollar. It's into the toilet over time. So the more toilet bound it gets, the higher the stock market goes, if you're comparing them to each other. All right, the volatility index, you can see it creeping back up toward a pretty low mean, which is near the 15s. That's saying that we're starting to get into the level where we're going to see some volatility here pretty soon. We're getting into more of a panic mode, but we're still up at highs, so things are still pretty good. Look at the housing index. So people are like, oh, the housing index is going to crash. I'm not saying anything for 5-6 weeks on a gap up, and it's consolidating here. Housing index looks strong to me. The Philadelphia Oil Service Index looks weak to me, right? So oils are looking weak. I don't know if that's because they're not letting us drill in the Gulf or the natural gas or the LPG, whatever. But I can tell you that the oil market is weak. The gold market is also weak, and the Bitcoin market is very strong. And the healthcare market is also strong. So I'm giving you, there's some mixed stuff going on, but primarily most of this stuff is good. If I started pulling up all the other indexes, excuse me, you'd be seeing that those are pretty good too. Okay, Apple. Apple's testing its 200-day moving average. This is the third day it's tested on its 200 moving average. And usually you get 1 or 2 tests a year of the 200-day moving average, that black line. What we're seeing is the 4th test, just recently. And so that is concerning. To me, that makes me think, and because Buffett's selling Apple, that makes me think that Apple is actually wanting to go lower. Right now, it's kind of stuck in this range between 180 to 200. If it gets to 200 on volume, it's going higher to 220, the way I see the chart. And if it gets down to 180, where it's testing that previous swing point, 179, 180, and it does it on volume, it's going down to 165. So to me, it looks right now toward the 165. It doesn't look as hunky-dory as it normally did. You could see the relative strength on this chart is only 53, when just a few weeks ago it was around 90. So it's not performing very well compared to the market at all. NVIDIA, on the other hand, is unbelievable. Now, I don't know if you follow me on this channel too much, but hopefully you do, because on January 4th, I came out with my predictions. I'm not a prediction guy, but I'm a probability guy. And I saw some probabilities on the charts that were saying, here are the 5 stocks that I'm choosing for the year. And you know what? I could be wrong just as much as the next guy, but I chose NVIDIA and an SMCI. So NVIDIA, I said it was around 480 or something, I think, when I made that video. And today it's at 730. This week I put out another video that says, take your money off the table on NVIDIA, or at least part of it. Be smart. Take some money off the table on NVIDIA, here in the 700s, 720, 730s, and also on SMCI. So that's the chart on NVIDIA. I'm going to show you a quickie on SMCI, and then I'll let you go. This is Tesla. Tesla's coming off the bottom, by the way. This is super microcomputer, SMCI. So you can look at this chart, and you can say back on January 9th or January 6th, or when I made that video on the 4th, we had a breakout on high volume, and then the whole personality of this stock has changed, and it's gone from basically 320 to over $1,000 yesterday. Today, it's extremely volatile, and we have this little candle over here, this red candle. It's a bearish engulfing candle. It's basically engulfed the high and the low of yesterday, and it's filled the gap up yesterday. To me, this looks like, and I said this is one you should sell off, because these straight up moves rarely can sustain, because all these people that made this money at 357, they're like, oh my God, I'm rich now, I'm going to sell. And so they start to sell. The short sellers jump in, they drive this thing down, And that's, to me, it looks like it probably is going to go back halfway. So it made a $700 move up. It probably is going to give back about $350 of that. So I wouldn't be surprised to see a $650, $700 handle on this in the next few days. I know that it wants to fill that gap at 810, 805, something like that. But take a look at this thing coming back to about 650 and then maybe settling in a range. I can't predict stocks. I'm not Nostradamus, but that's the way I see SMCI. You got to be smart playing these things. If you made a bunch of money, it's time to take a little bit off the table. That's the way I see it. Listen, I think we have a long weekend coming up with President's Day, so I hope you enjoy it and take your time to spend with your family and have some fun and enjoy your life, because we're only here for a short period of time, and we might as well make the best of it with the people we love. And I'm wishing you all the best. I'll see you next time on the next weekly stock market update. Take care. Bye.